You get paid on Friday, you check your account on Monday, and somehow, it's already gone. You didn't go crazy. No luxury watches, no private jets, not even a suspicious number of Amazon packages. And yet somehow your balance looks like it went through a paper shredder. Here's the thing. You're not bad with money. You're just living in a system where time works against your paycheck, but works for your investments. And once you understand that one simple shift, something really interesting happens. A tiny habit, like investing $35 a week, can eventually generate more monthly income than a lot of full-time jobs in America. Sounds ridiculous, right? But stick with me, because by the end of this video, you'll see exactly how the math works. We're going to cover why money feels tighter every single year, how weekly investing quietly beats inflation and market chaos, the compounding snowball that most people completely underestimate, and how a simple Fidelity index portfolio could grow a $35 weekly investment into nearly $1 million, producing around $8,000 a month in passive income. Once you see how this works, you'll never look at small amounts of money the same way again. I'm Jack, and what I'm about to show you is how ordinary people with ordinary incomes are building extraordinary wealth, just by investing a small amount every single week. Hit the like button and subscribe to start your financial freedom journey. Why everything feels more expensive. You are not imagining it. Things genuinely cost more now than they did just a few years ago. And there's data to back that up. According to the U.S. Bureau of Labor Statistics, consumer prices surged dramatically between 2020 and 2022, with inflation peaking at 9.1% in June 2022, the highest level in over 40 years. Food prices alone took a serious hit. Data from the U.S. Department of Agriculture shows grocery prices rose about 11.4% in 2022, one of the biggest single-year jumps in decades. And even though inflation cooled after that, the damage was already done. The prices didn't come back down, they just stopped climbing as fast. So what does that actually mean in practice? A grocery cart that cost around $100 in 2020 can easily run $125 or more today, depending on where you live. And that's just food. Housing, insurance, car payments, utilities, all of it has gone up. Now wages have been rising too. According to the Economic Policy Institute, wage growth in the U.S. has averaged roughly 3 to 4% annually in recent years. Which sounds fine on paper, until you compare it to those price increases. When costs climb faster than your paycheck, it creates a gap. And that gap is exactly why so many people feel like they're running on a financial treadmill. Working harder, but not actually getting ahead. Here's what makes this interesting, though. The stock market operates on a completely different timeline. The market plays the long game. When the economy feels shaky, it's easy to assume investing is too risky. You hear about recessions, market crashes, inflation, bank failures, and suddenly the safest place for your money feels like it might just be under your mattress, which, for the record, earns approximately 0% per year. The historical data tells a very different story. According to S&P Dow Jones indices, the S&P 500 has delivered about 10% average annual returns since 1926, including reinvested dividends. And that track record survived the Great Depression, the dot-com crash in 2000, the 2008 financial crisis, the pandemic crash in 2020, and the inflation-driven downturn in 2022. Every single one of those events felt catastrophic in the moment. But zoom out on the long-term chart, and the trend keeps pointing in one direction, up. Markets absolutely fall. Nobody's pretending otherwise. But over long stretches of time, growth has historically beaten inflation by a wide margin. And that's exactly where weekly investing becomes so powerful. Because it removes the one thing that ruins most people's plans, trying to time the market. Why weekly investing works so well. Most people assume you need a lot of money to start investing. They picture dumping $10,000 into the market all at once. But that's not actually how most wealth gets built. Wealth is usually built through consistency. Take someone investing $20 a week. That's $1,040 a year, which honestly is roughly what many people spend on random online purchases they barely remember making. At first, the results look pretty underwhelming. Year 1, you've put in about $1,040. Maybe a little growth, nothing exciting. Year 3, you're up to around $3,120 contributed. And with typical market returns and reinvested dividends, the balance might be somewhere around $3,700 to $3,800. Still not life-changing, but something important has started. Compounding. By year 5, you've contributed about $5,200, but the portfolio could be worth $6,800 or more. That extra money didn't come from new deposits. It came from your money earning money. And that's the moment the snowball really starts rolling. The bigger the portfolio gets, the more it grows each year, until eventually the growth becomes larger than your contributions. But here's the psychological trap that trips most people up. The mindset problem most investors face. The hardest part of investing isn't picking the right stocks, it's patience. Humans are wired to expect fast results. You go to the gym for 2 weeks and expect abs. We start a business and expect profit by month 6. We invest $100 and expect something exciting to happen by next Tuesday. Compounding just doesn't work that way. It moves slowly at first, almost invisibly, and then suddenly, very quickly. Think about planting a tree. The first few years look completely boring, nothing seems to be happening. But decades later, you've got something massive. The real mental shift is simple. Stop asking, is this growing fast enough? And start asking, did I invest this week? Because consistency beats perfection every single time. Once that mindset is locked in, choosing what to invest in becomes a lot easier. What makes a strong long-term portfolio? Rather than hunting for the next hot stock, smart long-term investors focus on a few fundamentals. Diversification is first. Owning hundreds or thousands of companies spreads your risk so that if one company struggles, others can still thrive. Index funds make this incredibly straightforward. Broad market exposure matters too because different sectors lead at different times. Technology might dominate one decade while energy or industrials lead the next. A well-balanced portfolio captures growth across the whole economy. You also want proven historical performance. Companies and funds with real track records, not just hype. Dividend growth is powerful because when companies increase their dividends, those payments can be reinvested into more shares, which then produce more dividends. That's compounding working on 2 levels at once. And finally, low fees. According to Morningstar research, higher expense ratios can significantly drag down long-term returns. Low-cost index funds keep more of your money doing the actual work. Put all of those principles together, and you get a portfolio built for steady, long-term growth. And that's where a few specific Fidelity funds come in. Example Fidelity portfolio structure. A diversified portfolio might spread across several funds covering different parts of the market. Fidelity Zero Total Market Index Fund, FZROX, tracks the entire U.S. stock market with a zero expense ratio, holding thousands of companies across every sector. Fidelity Mid-Cap Index Fund, FSMDX, focuses on mid-sized companies which historically have delivered strong growth as they scale up. Fidelity U.S. Sustainability Index Fund, FITLX, tracks companies with strong environmental and governance standards, often concentrated in innovative sectors like tech and healthcare. Fidelity Growth and Income Portfolio, FGRIX, blends large-cap growth companies with reliable dividend payers. And Fidelity Dividend Growth Fund, FDGFX, targets companies with long histories of actually increasing their dividends. Together, funds like these create a diversified mix of growth and income. Historically, diversified U.S. stock portfolios have averaged roughly 8 to 10% annual returns over long periods, according to data from Vanguard and Fidelity Market Research. And that's the assumption most financial projections build on. So let's see what actually happens when you combine these funds with consistent weekly investing. The $35 per week experiment. Here's an example. You decide to invest $5 a day, $35 a week. That's about $1,820 a year. Not exactly billionaire behavior, but you're consistent. Every week, no matter what the market is doing, you invest. Year 1. You have contributed about $1,820. Small start, but the foundation is there. Year 10. Assuming roughly 8 to 9% average annual growth, your portfolio could reach around $30,000 to $35,000. Still not retirement money, but the snowball is picking up mass. Year 20. You have put in about $36,400 of your own money, but compounding could push the portfolio close to $150,000 to $170,000. Now, the growth each year is measured in thousands of dollars, without you doing anything differently. Year 30. This is where it gets really interesting. With consistent contributions and long-term market returns, your portfolio could approach $900,000 to $1 million. And here's the part worth sitting with. You only invested about $54,600 of your own money over those 3 decades. The rest, the other 90% or more of that wealth, came from compounding, dividends, and market growth. From the portfolio doing the work. At that size, even a conservative 4 to 5% withdrawal rate generates roughly $40,000 to $50,000 per year, and higher dividend yields could push that even further. All from a habit that started with $5 a day, which is roughly the cost of a coffee in most American cities. The real lesson here. The specific portfolio matters less than the timeline. Most people dramatically underestimate what small, consistent habits can do over long stretches of time. We live in a world obsessed with overnight success, but financially, overnight success usually takes about 25 to 30 years. Consistency, patience, compounding, that's the whole formula. And the earlier someone starts, the easier the journey becomes, because time is doing most of the heavy lifting. Final thoughts. The reason weekly investing works so well is actually pretty simple. It removes emotion from the equation. You're not guessing. You're not predicting recessions. You're not waiting for the perfect entry point that may never come. You're just investing every week, no matter what the headlines say. Over time, that tiny habit quietly becomes something powerful. And eventually, your investments may start earning more than your paycheck does. That's when financial freedom stops feeling like a dream and starts looking like a math problem. If you enjoyed this breakdown and want more videos about investing, index funds, and building passive income, hit like and subscribe. I'll see you in the next one.